The broadcast is now starting. All attendees are in listen-only mode.
Good evening, ladies and gentlemen, and welcome to tonight's uh, investor update for the Tailored Investment Solutions Berkshire Hathaway Series 1 extension units. Tonight I'll be going over Berkshire Hathaway and how it has performed over the last 5 years, specifically what's occurred over the last 3 years, more importantly what's occurred over the last 12 months and why. The performance of our investment. The good news is that you've made a return. It's probably not as high as what I would have liked when we initially did the investment, but you are in profit, which is a good thing. Good to get that up front straight away. And also the outlook. You do have to make a decision as to what you want to do with the investment as it matures on the 25th of February this year. And those alternatives that you have as to what you need to do with the investment to help you make an informed investment decision. I hope everyone can hear me. If you can hear me, if you use a question section and say yes loud and clear, that would be great to get some feedback that everything's working well. Thank you. Excellent. Glad you're all awake. The question box can be used throughout today's or tonight's presentation as well if you have any questions about the investment. Excellent. Good work. Everyone's found that question section, which is great. Another important thing, there's a lot of investors that have been faithful Berkshire Hathaway and Warren Buffett disciples over the last 5 years for this specific investment. Now, those that have attended tonight makes up less than 20% of the total investors, which I find really intriguing. My kitchen rules, or what is it, maths now, Married at First Sight, I think it's called, is more important than tuning into the webinar to find out how their investment has performed, as well as what options they have moving forward. So I do respect and applaud each of you who have taken time out of your busy schedule to tune in tonight to see how your investment and your SMSF has performed. Some of you invested not just in your self-managed super fund, but outside of super, which is great as well, because all these investments are available not just to super, but to you in your individual capacity as well. So let's go on. Disclaimer. Look, this presentation has been produced by myself at the SMSF Club. We're licensed by RM Capital, which means I'm licensed to provide financial advice to you as clients. Many of you have elected to receive what's called general advice, and tonight's presentation is exactly that. General advice means that I haven't considered your individual circumstances when I've put together this presentation. Secondly, we're going to go through the performance of Berkshire Hathaway in the past. I'm going to give you a bit of my outlook and view of where the share price could potentially trade moving forward. But past performance is not necessarily a good indicator of future performance. Look, this presentation isn't regarded as personal advice. Following on from this presentation, if you do have any questions, then by all means speak to your SMSF Club advisor or email me directly, as I'm regularly make myself available to all investors. Okay, before I get started, diversification, the board game. Many of you have played this. A few years ago, we did a tour around the country, of which I'm looking forward to doing again in the coming few weeks or months, depending on where you're located, to play the board game I've put together, which is diversification. The aim of the game is to teach you principles about investing, the wonderful benefit of compound interest. Also, not just for you guys as clients, but for those people that have more time on their hands, and time is the essence for compound interest, but also to teach kids. So expect to get an invite to those events in the coming few weeks or months. In the meantime, if you want one of the board games, email admin@thesmsfclub.com.au. We're passing it over to you guys as clients, pretty much at what it costs us to produce which is close enough to $80. So if you want one of those, look, if you want to put your details in the question section, we get that afterwards, or email admin@thesmsfclub.com.au, and we'll send you down one of the board games. They're here. We have about 800 of them in the office, so they're taking up a fair amount of room. I'm sure many people in the office would like to see the back end of them. But after we do that, the money that's raised, we're actually using to donate them to the schools to not just teach your kids, but all kids in Australia the importance of working hard, saving, and investing. And I think creating wealth is as simple as that, especially when you've got time on your hands, and kids have got a lot more time. Unfortunately, majority of people learn the lessons of compound interest when it's way too late. And I'm sure many of the lessons that you've learnt when it comes to investing, I'm sure you wish that you knew when you were at school or taught at school. So the aim is to put them through all schools in Australia. The aim of the game is we're hoping to run. We will be running a game where we're looking to break the Guinness Book of Records for the most amount of people playing a board game at one time, which is over 2,500 people. So we need over 2,500 kids to be playing the game simultaneously to break a world record, which would be phenomenal. So Warren Buffett, tonight we're here to talk about Warren Buffett and the performance of Berkshire Hathaway. Now, I know you guys have known me for a long time. If you go back to the original Berkshire Hathaway investment, I know the majority of you personally and have met with you many times face to face. And you know how passionate I am about the world's most successful investor for many reasons, not just because he's accumulated so much wealth, but for some of his real common sense theories around life and investing. Investing is really simple. He lives a very modest life despite his significant wealth. He was born in 1930. His dad was actually a politician after he started work as a stockbroker. Buffett went on to study at university. He was offered a job as a stockbroker in New York, but eventually he relocated and set up his own investment partnership in Omaha, Nebraska. He ran that partnership for, I think it was about 5 or 6 years before he purchased a company called Berkshire Hathaway. Now, Berkshire Hathaway, if you go back to the origins, if you look at the history of Berkshire Hathaway, it was actually a textile company back in Omaha at the time. Warren Buffett was essentially, his investment philosophy was walking around looking for cigarette butts that you can pick off the ground, which cost you nothing, but you might be able to get half a puff out of. That was his description of what his early investment ethos was, something that someone valued very little, of which he was able to extract some value out of. And Berkshire Hathaway, as the textile company, was certainly met that description. If you ask Warren Buffett, you head 10 to one of the many or the yearly shareholder meetings in Omaha that he holds every year, he generally talks about the worst investment he's ever made is actually buying Berkshire Hathaway, the textile company itself. So it wasn't too long after he purchased the company that he put the textile company into administration, or closed it down rather than, putting it into administration. He closed down the textile company, but the Berkshire Hathaway name stayed the same. He didn't want to pay money to have the business details changed. So he kept it as Berkshire Hathaway and then went and put a lot of investments in that company. The first of which was buying insurance companies, when he realized that as an investment manager, if you buy insurance companies, you get the benefit of the float. The float is the cash or the liquid assets that an insurance company needs to hold in the event of claims. Now, when you run an insurance company, certainly in the United States at this time, rather than just having the money sitting in cash, which many insurance companies did at the time, Warren Buffett invested that float. And he invested that float in a lot of companies, of which some of the companies he still holds today. He was able to generate not just dividend income off those holdings, which now exceeds almost $100 billion a year, but also huge capital growth for holding what is now arguably the best stable of global brands in the world as any investment manager, some of which are American Express, Coca-Cola, Geico, Wells Fargo, Apple more recently, Burlington Northern Santa Fe, Heinz. So huge companies that are global brands he now owns. During that time, he's gone from living in the same house through that entire period, which is actually quite a nice house in Nebraska. It's not worth a huge amount by any stretch of the imagination, especially when you compare it to the property prices here in Australia. But he has amassed a fortune, and 99% of that fortune he holds in Berkshire Hathaway stock. More recently, I think it was about a decade ago, Buffett came out and announced that he would be passing on very little of his wealth to his kids. He's going to donate the majority of that to charity, of which the charity of his choice was the foundation that his good friend and long-term business partner created, which was the Bill Gates Foundation. Bill Gates has been a director, I think, since the mid-90s of Berkshire Hathaway, and the person I believe that will be ultimately Warren Buffett's successor as the CEO of Berkshire Hathaway. Obviously, he's got more roles than that. The other main role is the allocation of capital. Where I mentioned before, it's around $100 billion a year they earn in dividends. Warren Buffett's role has always been sticking to his core expertise, which is making investment allocations for that capital to make it create future dividends for the shareholders of Berkshire Hathaway. So that's a bit about Warren Buffett and the history of Berkshire Hathaway. Let's have a look at the share price. The annual share price since 1965, I think it was, when he took over Berkshire Hathaway. So for just on 53 years, it's been just over 20%. That's an average annual share price rise, 20.7%, which is why he's created so much wealth. It started very little, and 20% a year creates a lot of money. He realized that he was going to become extremely wealthy. The only thing that was going to stop that from happening is if he died young. Warren Buffett's 88 years of age. His right-hand man, Charlie Munger, is 93 or 94 now, I think it is. So he has lived a long time, and he has amassed a huge fortune. That fortune is in stable, solid, diversified company called Berkshire Hathaway. Let's focus on the last 5 years. That chart actually goes back to 1996, but the 20% return is over the last 53 years. Let's look at the last 5 years. Last 5 years from when the very original Berkshire Hathaway investment was put in place. So while 20% a year has been the performance since 1965, over the last 5 years, the annual average return for Berkshire Hathaway has been quite slow. The average annual share price increase is, hang on a minute. Someone's telling me they can't see any of my slides. Oh, hang on. Sorry, guys. There's a few more questions in here. I'm on to it. JB, we're having a message here that says, waiting to view Justin Beaton's slides. No slides. I can see them at my end. Let's see what I'm doing wrong. Can you see my slides? Yes, sorry about that. Let's see if we can go back. So we've done that. That was the first slide. That was a disclaimer. There's my board game. Looks pretty cool, huh? There's Warren Buffett and the text. There's a chart for since 1996 and the performance of the 20% over the last 53 years. Now, if we focus on back to where we were meant to be, thanks for letting me know, guys. If we focus in on where that square is, which is since the original Berkshire Hathaway Series 1 investment took place, annual return for Berkshire Hathaway for the last 5 years has been 8%, which is a lot less than what he's achieved for the last 53 years since 1965, which is slightly disappointing. I think it's more of a reflective of a few things, and I'll go through those things tonight. If we focus more just on the last 12 months, and that's probably where we've seen a slowdown in the return, the last 12 months, the actual share price of Berkshire Hathaway has done very little. In fact, it's only up 3.4%, which is frustrating. If you go to the highs of where it was just mid third quarter last year, you would have essentially made a 60% return on your investment on the Tailored Investment Solutions investment. Because we've seen a lot of those profits erode with the market falling late last year, and Berkshire Hathaway was also affected, we've seen those profits erode to not be up 60-70% to providing a return of 16% is what we calculated as where Berkshire Hathaway traded at last night. So let's have a look at how the investment went. The initial price back for Berkshire Hathaway Series 1 investment back in 2014 was $134. That was the initial averaging price. If you remember, we had a few risk management strategies built into the investment. One is that the initial amount is protected, the loan amount, your initial outlay is the prepayment of interest and hedging fees. You borrow in a certain amount, that is the prepayment of 3 years of interest and hedging fees. And if the investment didn't go up at any time over the investment period on a yearly basis, you would have lost that upfront outlay. We also implement protection on the loan amount, which is also protected by a limited recourse loan internally built into the investment. We implement dollar cost averaging. Dollar cost averaging reduces the impact for the first 3 months and the last 3 months of the fluctuations in the Berkshire Hathaway share price. The third risk management technique that we implement is that we harvest the growth on a yearly basis, if there is any growth, by paying out coupons. Berkshire Hathaway does not pay a dividend, so what we do is if there's any gains in the investment on a yearly basis, they are paid out to investors in the form of coupons, up to 10%. Now, these coupons in the final value are influenced by the currency. That can either enhance our return or decrease the amount that we receive on the coupons of the final value. So the initial averaging price was $134 US. After the first year, the investment was up around 7%, and you were paid a coupon of 7.24% on the loan amount. Okay, so that was the first year gains paid out. Right, we pay them out on a yearly basis. The next 12 months, the share price did bugger all. In fact, the second coupon was only 1.16%, if you recall. Then at the third year, which was the maturity of the first 3 years of the investment, the investment was up around about 14-15%. Then you're given the option to use that 14 or 15% rather than being paid out as cash, but use that to prepay that for interest for the following 2 years, which takes us up to where we are today. So that's the BRK strike extension. That's when we extended it, which was essentially just before the maturity of the investment. I think it was February 2017. So we used the gains from the third year to fund it for the next 2 years. 12 months later, the first coupon of the extension units was up 3.58%, which you were paid out. Then the second coupon, which was 12 months into the investment, you were paid out 8.81%. Where we are today is the final expected value, because what we're doing is we're exiting the investment. We've exited the majority of the investment already by implementing this dollar cost averaging to ensure that if Berkshire Hathaway share price falls tomorrow, even though maturity isn't till next week, if it fell substantially, we're locking in those gains because we've already offloaded some as per the PDS. So the expected final value is around 3.5% as to where the Berkshire Hathaway share price sits today. So they're the coupons and how we've paid it out. They're paying out the gains on a yearly basis. So let's have a look at how that works as an example. So let's look at an example of $100,000. So this is 100,000 units at $1 a unit in the Tailored Investment Solutions Series 1 extension units. Your first investment for Berkshire Hathaway Series 1 was $20,850. That was your outlay for the 3-year investment. The first coupon was $7,246. The second coupon, $1,165. We then used the third coupon to fund the next 2 years. So you didn't receive a payment there because you used that payment to fund it for the next year to extend the maturity date, which created the Series 1 extension units. The first coupon, which was 12 months after that, was $3,500, and the second coupon was $8,810. If the Berkshire Hathaway share price is where we are today, the expected final value is $3,500 for the 100,000 units. That means the total coupons paid over the entire term for 100,000 units, or what was an initial investment outlay of $20,850, it means the total amount you would have received over the investment term is $24,302. That's provided you a return on your investment of 16.55%, assuming the maturity price is final averaging price is where we are today. So the good news is that you made a return. It's not as much as I would have hoped. It's not as much as what it would have been 6 months ago, but you've made money. And during this time, over the last few years, it's been a very tough time to generate a return, not just on the share market, but across all asset classes. And I'm sure you're familiar with the tough markets it's been over the last few years. So why has Berkshire done nothing over the past 12 months? Because it's that 12 months of doing nothing that has been frustrating for us and what has diluted the returns on our investment. Let's have a look at what we've done in the last 12 months, more specifically over the last 6 months, 3 months, 5 months. So it's only over the last few months that we've seen some of our gains erode. And it's not just Berkshire Hathaway, but the United States share market, global markets. We've seen almost 7 years of growth on the Australian share market erode in a few months, like we are with this global uncertainty that has caused the share markets across the globe to fall, and Berkshire Hathaway has been no different. So a few things. Why has Berkshire done nothing? First of all, we've had global growth uncertainty. China and the United States, there's been a lot of trade tension as they're negotiating tariffs, which has plagued the market for the last 6 months. Hopefully, we've seen today in the media that Trump and China are close to a resolution. We've had US earnings volatility. We've had the risk of rising inflation in the United States. There's also been rising interest rates in the US. Now, the majority of Berkshire Hathaway's holdings, while they're global companies, the majority of them are listed in the United States. And we've had political dramas and more political dramas in the United States than what we have here in Australia, which is hard to believe given the amount of leaders that we've had over the last 8 years here in Australia and the constant changing of politics. In the United States, more recently, it's the longest period that the country has been shut down, as Trump and has been trying to negotiate or plead for some money to build his wall, and all of that creates uncertainty. All of those things create a lot of problems for the overall economy, at least in the short term until they're resolved. So why has Berkshire done nothing over the past 12 months? Global growth uncertainty, China trade tension, rising interest rates, risk of rising inflation, and political dramas. What's important to note is that it's nothing related to Berkshire Hathaway. Like, it's not as if Berkshire Hathaway has made some bad investments that have gone wrong. It's not as if Berkshire Hathaway is profits are down. It's completely the opposite. In fact, Berkshire Hathaway is sitting on the largest cash pile it has ever done so in history, which is around $130 billion. So when we look at the current state of Berkshire Hathaway, it's looking the best it ever has, not just in the last 12 months or the last 5 years, but the last 50 years. To give you an idea of the size of Berkshire Hathaway, it's in the top 5 largest companies in the world. The market capitalization of Berkshire Hathaway is sitting on around 650 billion Australian dollars right now. To put into context, if we added up BHP, CBA, National Australia Bank, Telstra, Wesfarmers, ANZ, Westpac, some of the largest companies here in Australia, if we added all of them together, they are still not worth more than the Berkshire Hathaway company itself. Berkshire Hathaway market capitalization is larger than if we added BHP, CBA, NAB, Telstra, Wesfarmers, ANZ, and Westpac together. Just to give you an idea of the size of this company, yet, despite its sheer size, it still employs less than 30 people. Because Berkshire Hathaway itself is merely a holding company. Now, of course, the companies that it's invested in have a lot more employees than 20 odd. Like American Express has a lot more companies than more staff than 20. If you look at Coca-Cola, it clearly has a lot more staff than what Berkshire Hathaway holds. But Berkshire as a company itself is very simple to run. It's very easy to manage. And it's quite easy to come up with a valuation for. And rather than my valuation, I think what's important is Warren Buffett's valuation of his company himself. So if we look over the last 5 years, despite the share price only going up 8%, which is quite slow, especially if we compare it to the performance that's achieved historically, it's a lot less than the average return that Berkshire Hathaway has enjoyed since 1965. But if you look over the last 5 years, Warren Buffett has been somewhat active. And I say somewhat active because while he's been able to find some companies that meet his strict criteria, it's by no means as many as he would have liked. Warren Buffett has come out and said that he's looking for an elephant-sized acquisition. Warren Buffett does not want to be sitting on a cash pile of $130 billion. There's been many times throughout history where he's wanted to invest. However, because of his strict formula, he's had no other option but to leave money in cash. And that's where he finds himself today. He will not be making an acquisition unless it's a quality company, quality management, well run, easy to understand, and most importantly, the share price is trading at a discount. He's buying it at a cheap price. And that's ultimately why he hasn't been able to make any acquisitions of late, of large size. So if you look at some of the companies he bought Duracell, Berkshire Hathaway Automotive. Back in 2015, he made his first investment here in Australia with IAG, which was $500 million. Sounds a lot and probably is a lot for IAG, but for Berkshire Hathaway, when it's sitting on $130 billion worth of cash, $500 million is not much at all. Precision Cast Parts. Apple made its first investment in May 2016. He's bought an airline to add to his other airlines, which is the leasing jet company. He's bought into Goldman Sachs. He's bought additional stock in Apple, where over the last few years the Apple shareholding is now worth $42 billion. So he's accumulated a fair amount of Apple stock. 21st Century Fox, motorcycles, pay TV, charter brokerage are just smaller acquisitions that he's made with a few $100 million, which again is small change for Buffett. He's waiting for a little elephant-sized acquisition, and he's looked at a few companies in the past that he's looked at over the last 12 months to buy, but he's either been trumped by someone else paying too high of a price, of which he wasn't willing to negotiate on, and that's simply been the story over the last 5 years. He's accumulated a huge cash pile, and until he makes large acquisitions, the market is frustrated, and no doubt so is Buffett, because the return on cash is a lot less than what he would like to achieve if he deployed it into some of the largest companies in the world. But he's not willing to give up on the basis that he has a strict formula that has worked for 53 years. He's not going to change on buying companies at a cheap price rather than paying a high price. The Warren Buffett way, when he's making an investment, as I said, it's got to have quality management, long-term track record of providing superior returns to investors, simple and easy to understand business model. And the fourth part is trading below intrinsic value. Now, while Warren Buffett has the opportunity to buy any company in the world, there's one company that he's bought just recently, and he hasn't bought it for quite a period of time because of this model, the 4-point criteria. But in addition to these 4 criteria, he's also got the corporate governance, which restricts him making a large acquisition in this company. That company is Berkshire Hathaway itself. So in the second last quarter last year, Berkshire Hathaway bought back $1 billion worth of shares in Berkshire Hathaway. Now, this sends a very strong message to the market. That is that Warren Buffett is now creating somewhat a floor under the share price. He also believes that the company is trading at below what he calculates as intrinsic value. So he's buying the stock cheap. Warren Buffett is telling the market that he believes Berkshire Hathaway is trading at a discount to what is fair value, which is interesting. Now, my belief, and I think many of you followed my lead, when Warren Buffett bought IAG, I recommend it to all clients to buy AG as well. And we've made a lot of money in IAG since. Now we've got the opportunity where we sit in on Berkshire Hathaway stock and we face the opportunity or the decision to either let the investment mature or to extend it for another 3 years. If Warren Buffett's buying stock, I don't think exiting the investment at this time is the right decision for your financial future, which is why we've come out with a new investment, giving the opportunity to take part in Berkshire Hathaway for the next 3 years. So Warren Buffett sends strong signal to market with Berkshire Hathaway $1 billion buyback. Berkshire Hathaway buys back $928 million US of shares in Berkshire Hathaway. No doubt, and we'll find out in a few weeks' time, I believe Berkshire Hathaway has continued to buy more stock Warren Buffett has continued to buy more stock in Berkshire Hathaway for that last quarter. They haven't announced their purchases or acquisitions from October to December yet, but I expect that in their annual letter to shareholders, which will be released in a few weeks' time. That'll be great reading. If you want a great read, go back every year. BerkshireHathaway.com is the website. Download every letter to shareholders Buffett has written since 1965. That'd be the best book that you could ever read. That new one for the last 12 months, the yearly letter to shareholders, is expected out in a few weeks' time, and that'll give us a clear guidance as to how much Warren Buffett has bought, in addition to the $1 billion worth of stock that he bought in the third quarter last year. So if we look at the last time Warren Buffett purchased stock in Berkshire Hathaway, the last time that it was trading below its intrinsic value, where Warren Buffett could buy stock in Berkshire Hathaway, was back in the last quarter of 2012, which is that period just there highlighted on the chart. If we go back to 2008. So he purchased stock in Berkshire Hathaway where the B class shares was trading at approximately $84. 3 years later, the share price was up 57%. Now, when Buffett comes out and says he's buying stock, naturally the share price goes up. And we saw when Berkshire Hathaway came out and made the announcement they bought back $1 billion worth of stock, the share price within a day was up 5%, just recently in early January. Hopefully, while past performance doesn't equal future performance, when Buffett buys a stock, it sends a clear message, and a lot of people, not just myself, follow his lead and buy the stock. And last time that occurred in 2012, we saw the share price of Berkshire Hathaway skyrocket as a result for 3 years. What's also interesting is that when he purchased stock, it followed 12 months of the share price doing nothing. Very similar to where we find ourselves today. Over the last 12 months, the share price has essentially done nothing. It's up just over 3%, which is bugger all in comparison to the past. So in periods of the share price trading sideways, Buffett looks at buying stock. We generally see a high re-rating of the stock thereafter. So look, the summary of where we are today. Look, you've made 16% from the original investment. Look, it's not a high amount, but it's not a loss. You've made money from this investment. And while I've been disappointed with the return, it's been fair in comparison to other asset classes and other investments that you might have looked at investing in at the time. Not many asset classes over the last period, 5 years, 3 to 5 years, or 5 years it's been since the inception, has gone up in value. So we have produced a return, which is good. Domestically, we look at the Australian share market and even the property market. It has struggled, not just over the last 3 years more recently over the last 12 months. Interest rates are at record lows, so fixed income investments aren't really a good alternative. And with the Royal Banking Commission, the banking environment under increased scrutiny, I can't see much happening in the next few months, 6 to 12 months, until we start seeing a free flow of funds into the market. So why I'm mentioning this is that, like, you're getting a coupon, you've got money in your bank account in your self-managed super fund. The majority of you, what are you going to do with it? You can leave it there in the bank account earning 1.3% if you're lucky at the Macquarie bank account. Some of you earning nothing because it's below the threshold, where Macquarie have just changed the rules. If you've got less than $5,000 in the bank account, they're paying zero. I'm not saying that domestically the share market is going to go down. I'm hoping that it's still going to go up, and I don't know what's going to happen with the property market. I'm not a property expert, but I do own a lot of property. But if I've got money right now, and looking at getting a coupon, even though the final value isn't a huge amount, if you're looking at extending it, you're going to have to add capital or reduce your investment amount from your original one. You need to look at alternatives. So if Warren Buffett's buying Berkshire Hathaway right now, then I'm happy to put my money to work where Buffett's buying stock. And if he's buying Berkshire Hathaway, then I'm more than happy to add to our investment. And that's sort of the decision that you've got to make. If he can't find an acquisition to invest his $130 billion in anything other than Berkshire Hathaway, so he buys Berkshire Hathaway stock, then that's good enough for me. The last time he purchased shares in Berkshire Hathaway, the share price went up 57% over the following 3 years. Now, I'm happy with half that. But hopefully, past performance is an indicator of future performance, and we can see the next 3 years go up as the stock gets re-rated. And some of the acquisitions that he's made over the last 10 years continue to pay high dividends. So as an investor of Series 1 extension units, you need to make an investment decision. You've got two options. The first one is sack Buffett and let the investment mature, take the final value in cash, and look at investing that money elsewhere. Now, if you just leave it in the bank account, you're choosing to invest it in the bank account, earning 1.3% if you're lucky. Or alternatively, continue with Buffett, enter into a new tailored investment solutions, Berkshire Hathaway investment. Provides you, just like the first series and just like the extension units, a leveraged exposure to Berkshire Hathaway for the next 3 years. That's the alternatives. For me, we'll go back to the summary. While 16.5% is disappointing, it's a return. It's better than what we get for fixed income, and it's probably still one of the best investments in my portfolio. So you can sack Buffett or continue with the investment. So let's look at the new investment. Exposure to Buffett's investment company, Berkshire Hathaway, 100%. It's leveraged exposure. You also do gain exposure to currency movements, but they have very little impact on the overall return. In fact, the currency only impacts the gains on the investment. That could improve the return or reduce it. Again, there's 3 risk management strategies built into the investment, which is a dollar cost averaging on the way in and on the way out. It's that harvesting of the growth by paying out the annual coupons of any gains in the first and second year up to the 10% mark. And then the final value being the gains over the 3 years less the coupons that have been paid. So it's exactly the same structure that you guys have invested in previously. The third risk management is the internal limited recourse loan. So you outlay the upfront amount, being the interest and the hedging costs. That's the maximum amount you can lose for the 3 years. You can't lose any more than that amount. So it's quantified downside risk. The borrowing rate, because interest rates have gone up in the US, they have increased. So the cost of the investment has gone up 1% a year. It was 4.95% that we're borrowing at 5 years ago and 3 years ago. Now it's 5.95%. So that does increase your outlay a little bit. There's 2% currency hedging fee like we've had in the past. 100% borrowing for your self-managed fund, or if you choose to invest in your own name. Quantified downside risk being your outlay. Every quarter you can redeem, but that's more of a profit-taking mechanism. And as I said, there's the potential for the yearly income distributions via the coupons. It's a 3-year term. So if we look at 100,000 units as an example, total notional exposure, 100 grand of Berkshire Hathaway, your investment amount is 23,850, which is the 5.95% interest rate plus the 2% hedging fee per year times 3, which is the investment term. That is your outlay. So if we look, you go back to that chart, the last time Berkshire Hathaway or Buffett purchased stock in Berkshire Hathaway in 2012, where the market had gone sideways for over 12 months, like we find ourselves here today. If you invested 100 grand, 23 grand outlay, if the share price appreciated by the 57%, your investment would be worth 51 grand. Right, so while past performance is an indicator of future performance, I think Buffett is a good judge of what makes a good and bad investment. If he's happy to continue to hold Berkshire Hathaway and add to it, as I said, so am I. So while that's past performance, hopefully we can get a similar sort of return over the next 3 years. Key risk, there's no guarantee the units will generate a return at all. If it didn't go up at all, you're going to lose the 23,850, which was the outlay. It does need to go up by the interest and the hedging fees per annum for you to break even. So while the share price has gone up, the share price is up around 24% over the period, the return to you is 16.5%, which is because of the borrowing rate. We need it to go up like 8% per annum for you to break even. Your outlay 23,850 in this $100,000 example is at risk. There's counterparty credit risk, which is tailored investment solutions, and we do a back-to-back hedge with the investment bank, and they're some of the largest global investment banks in the world, some of which Berkshire Hathaway has shareholdings in, interesting enough. But this is a summary of the key risks. You should read the product disclosure statement. The PDS is dated the 28th of January. Is available by emailing myself or speaking to your specific SMSF advisor. Another thing that a lot of people say, and I'm not hiding that these blokes are getting on in their age. Buffett's 88 and Charlie's 93 or 94 now. When they pass away, eventually that's going to happen, right? These guys can't live forever despite how healthy they are and how well they've done for so long. Now, if they do pass away, as I said, I think the company is very simple to manage. It's simple to run. I believe Bill Gates will be taking over the CEO. And I believe the company is going to turn around to being a dividend-paying stock. And when that happens, I expect the share price to be re-rated significantly on the upside. So I want to hold it for that period. And as time passes, even Buffett and Charlie will agree as economists that their days are limited. If they do move on or pass away, God forbid, and Gates takes over, even if Gates doesn't take over and it doesn't become a dividend-paying stock, I expect the share price to actually be rated on the upside as the uncertainty that's underpinned the stock being his successor or their successors. What's going to happen to the share price? Now, the only company that I know that was similar, that they had a very strong leader that dictated the growth of the company, was Apple. Now, a lot of people knew that, it was no hidden secret that Steve Jobs was dying of terminal cancer, and the share price sort of did nothing until he actually passed away. He passed away on the 5th of October 2011. Many people sat on the sidelines because they thought Apple was going to fall over, like it did when Steve was moved on out of the company in the 90s. However, 12 months later, the Apple share price was up 72%. As the market realized, it's like, well, hang on, it's business as usual for Apple. Does make a difference with Steve or not, the company is going to continue to operate. So I believe that the share price, like Apple did for a few years prior to Steve Jobs passing away when he was going through the fight with cancer, the share price struggled because of that uncertainty. And I think Berkshire Hathaway has struggled recently because of that uncertainty. And I anticipate that in the next few years that they will eventually retire and move on. Hopefully not die at the same time, but that could be possible as well. When that happens, I anticipate the share price will be re-rated significantly as the market realizes, hang on a minute, Apple, that's now one of their largest shareholdings at Berkshire Hathaway, continues to sell iPads and iPhones. Coca-Cola continues to sell Coke. People continue to use American Express credit cards, and Goldman Sachs and Bank of America continue to make money as they've done before. I think while I believe the share price will be similar to Apple, I believe Berkshire Hathaway is completely different in that Berkshire Hathaway earnings do not rely on Charlie Munger or Warren Buffett. So I anticipate the share price to go up significantly. So where I'm optimistic of the outlook of Berkshire Hathaway is, one, for this re-rating of the share price. The uncertainty gets eroded from the market when eventually they do move on and the future of Berkshire Hathaway becomes clearer. What I anticipate under a Bill Gates management, and also as a dividend paying stock as opposed to reinvesting their dividends that they've done previously. I expect that re-rating to be quite significant. If that doesn't occur, we've got the stage of Warren Buffett's buying the stock now, which creates a floor in the share price. Well, it's certainly a perceived floor. And Buffett's sending a clear message to us as a market that the best acquisition, the cheapest company on the share market is in fact Berkshire Hathaway itself. The last time he purchased stock was in 2012, and he was right. The share price went up a lot after that for the 3-year period. So they're the main reasons why I think the outlook for the next 3 years is a lot stronger than what we've experienced over the last 12 months, which has been frustrating for me as a manager of the Tailored Investment Solutions investment, seeing a lot more of our profits would have been realised had this had the market not had a correction over the last 6 months. But hey, we can't control the market. What we can do is assess what caused it, which I believe has got nothing to do with Berkshire Hathaway, but more external events. And if it's external, then maybe it's a good time to be looking at buying or extending the investment in this case, rather than exiting it, taking their money and leaving it in a bank account. And that's sort of what we're faced with where we are today. So look, if you want a copy of the PDS of the extension, it's essentially the same as what you've done previously, except the cost has gone up by that 1% a year for the interest cost. But email me, justin@thesmsfclub.com.au, or speak to your specific SMSF Club advisor as to what options that you have moving forward, so you can make an informed investment decision as to how you want to proceed. As I said, we're going to be paying a coupon. The coupon is around 3.5%. If you're looking at maintaining your units, you're going to need to add a little bit more capital. Some of those coupons that have accumulated over the last few years back into the investment to continue it for the next 3 years. We've made a return, which is thumbs up. That's good. Baby steps moving forward. We would have all liked it to be bigger, no doubt, but a return is a return, and you don't go broke making a profit, even if it is a small one. And where we sit today, there's not too many great investment opportunities, and if we're finding it hard, Warren Buffett's finding it hard as to where to deploy his cash. I'm happy to follow his lead and buy an investment that has provided us a return over the last 5 years. So look, I'll go to questions. If you've got any questions, I don't think there's been many questions, although I haven't really been looking at it. Hopefully we've had the screens working, which is good. If you do have any questions, we'll wait around for a few minutes to see if any questions come through. If not, look, as I said, speak to your advisor. The investment matures on the 25th of February. The new investment closes a week later, so you've got a few weeks to make a decision. So it looks like there's no questions. Look, if you do hold some of the other investments, tomorrow night we have an investment update for Berkshire Hathaway Series 2. Now, the Series 2 extension, that is going to be paying out a full coupon this year. So the coupon amount is expected to be the maximum amount, which is 10% of the investment amount. So, which is great news for Berkshire Hathaway Series 2, which I think a lot of you own as well. So, look, that's going to be paid. I think the calculation date, if I look, is in the next week. It's the 18th, maybe, of February. The coupon determination date. Sorry, it's the 15th of February, so Friday night. Where we are today, that is a maximum coupon, so 10%, which is influenced a little bit by currency, so it could be a little bit less or more than that, which is good news. You will need you need cash. That would be cash, so you can look at investing that coupon again into Berkshire Hathaway if that's what you wanted to do. That is an option. I hold Berkshire as well. Do I need to watch? So look, no, it's going to be the same update. All the difference is that rather than the final value being 3%, your coupon is the maximum amount. The rest of the story is going to be the same of the outlook, how the share price has traded previously, what's caused the share price to struggle a little bit over the last 12 months, which is market related, and what you can do with the coupon. So if you watched tonight, there's probably no need to tune in tomorrow. However, just remember that you do have additional money that will be paid in your bank account, being that coupon. You might want to consider how to deploy it. Justin, will this presentation be recorded? Yes, it has been recorded. So yeah, you can download it on the mentoring section of our website, or email me or Grace, and we'll be able to get you a recording. No problems there. So I think that's it. Thank you for tuning in. I hope you learned something. If you've got any questions or concerns, then I'm happy to speak to you in person over the phone over the next few weeks. I intend for Grace to arrange meeting times with all the advisors, with their clients over the coming few weeks, just to discuss through their options. But thank you for tuning in, and good night.